We offer this video to help the viewer interpret the powerful F.A.S.T graphs, fundamental analyzer software tool, earnings and price correlated charts. So before we get started and go through each of the 5 examples in our article, we're going to do a little orientation on what the graphs are and how they work and what each of the lines represent. The most important line on the graph is the orange line, and it's calculated using one of 3 formulas that are widely accepted in helping determine the intrinsic value of a company based on earnings and cash flows. The blue line is the normal price earnings ratio that the computer simply tries to calculate to determine over whatever period of time is being measured. Here we're looking at a 20-year graph on Kimberly-Clark, the maker of Kleenex. And this is really like a barometer. You can look at this, and this line turns out to be 17.4 in this example, and you can see how often the black monthly closing stock price line either traded above that price earnings ratio or below that price earnings ratio. The light blue area connotates dividends that are paid out of the green shaded area, which is a mountain chart of earnings. So by visually here, you can look at how the price action of the company has been historically, what its earnings achievement has been, how the market has normally capitalized it, and then there's a lot of data to the side of the chart, like current price to date, the current price earnings ratio, dividend yield, normal PE ratio, earnings growth rates. The formula, this is GDF stands for Graham-Dodd, and EDMP stands for EDMP, or earnings determined market price, Graham-Dodd modified formula. And then we'll look at one that'll have PEG ratio. Gives us debt, the exchange. At the bottom of the chart is earnings per share. The change per year is listed on 20-year charts. We skip a year because we don't have room to put all the data. And then we show the dividends. And then we're going to be looking at associated performance charts that assume a $100,000 investment in the beginning of the first day of the graph and held to the current day. And then we're also going to list the dividend cash flow. We're going to show the rate of change of dividend growth, the payout ratio, what the actual cash dividend, starting returns over the period, etc. One of the points that is going to be most important during this video is to notice valuation. For example, in this graph you have Kimberly-Clark starting in value, or the price basically touching the orange line, and it's close to touching the orange line at the end. So you're going to see a 5.8% growth rate culminates in almost the same rate of return, or a 5.1% rate of return. That's the importance of valuation. For each of the 5 examples covered in this graph, we're going to shorten the time frame to 11 years, and that's just to kind of focus in a little more. I want to focus on what valuation looks like at the beginning period, because this is the infamous, lost decade starting in 2000, where prices began correcting in 2001, which was the recession, and then through 2008. But let's look at Kimberly-Clark now. Here we're using a Graham-Dodd formula. It's Ben Graham's famous formula for valuing a company, because the growth rate during this 11-year period for Kimberly-Clark has only averaged 3.4%. So this is the orange earning justified valuation line, which calculates out to a fair value PE of 15. The blue line simply shows that the market has priced Kimberly-Clark, quite often above that, or almost a 16 multiple. But what you can see here is, in essence, when the price is touching the orange line, it's in value. When it's above the orange line, it's overvalued, and of course below the orange line, it's undervalued. But what we're really trying to show here is that Kimberly-Clark has been a 3.4% grower since calendar year 2001. The dividend has increased each year, as you can see at the bottom, and then we're showing the rate of change of earnings growth each year is also listed at the bottom of the chart, and you can see the down year here. We're going to move on to Kimberly-Clark's 11-year performance now. $100,000 invested at the beginning when the price was overvalued would have grown to only $102,000, a very low rate of return, essentially breaking even, but slightly better than the S&P 500. But thanks to dividends, the company did almost twice what the S&P 500 did. I want you to also notice that because valuation was high, the entry-level yield in 2001 would have been 1.7%, where today you can buy Kimberly-Clark with a 4.2%. But the most important perspective we want to have in each of these examples is how the current price is trading at a historically low valuation, which is why the dividend yield is so high. Moving on to our next example, we're going to look at Unilever and Adr. Unilever is probably best known for its home care products like Vaseline, Pond's soap, etc. But I want you to see over the last 11 years, or 10 and a half years, because the 11th year actually only includes the current year we're in, You can see that earnings have been rather consistent. There was a down year coming out of the recession of 2001 and a down year following the recession of 2008. But otherwise, earnings growth has been pretty good. But even on these down years, the company was very profitable. This has been the historically fastest grower over this decade of any of the five we're going to look at. Earnings growth was almost 19.6%. The current dividend yield is 3.6%, and it does have a higher PE than most at 17 times earnings. But as you can see by this graph, it's trading at a historically lower valuation than the market has typically appraised it at. Because it's an ADR, we've had some problem bringing in the debt calculations. We've recalculated that. The debt here is about 0.66. That's the debt to equity ratio. So ignore this 252% debt level. You can see the change per earnings per share at the bottom here, but now let's move on to performance. A $100,000 investment in Unilever would have grown to about $190,000, averaging about a 6.4% compounded return. The difference between that and their earnings growth rate has to do with the beginning overvaluation that we see here. But otherwise, you can see that the dividend growth has been very attractive. One point I want to make is it looks like there's a cut in dividend from 06 to 07, but that's because they paid a special 33% dividend in 2006. Otherwise, their normal dividend payment actually grew each year. $100,000 would have, thrown off $49,000 in dividends over the last decade. That's in contrast to only $15,000 for the S&P 500. Our third example is Abbott Labs, probably the most consistent of the five stocks we're going to look at. Earnings growth has averaged about 9% during the last 11 years. But just to point something out about how consistent this company is, if we shorten the time frame to only 6 years, you'll see that Abbott Labs' earnings growth rate has actually increased to 10.7. So it's a very consistent grower. But what you can see in the 6-year chart here is the price is historically low, even though nothing has changed in earnings. In fact, earnings have continued to be very strong here. So this is simply the market undervaluing this company for no apparent reason, in our view, simply based on the fact that there's some pessimism out there in the market, especially with large cap growth stocks. As we indicate in the article, that's why they're so undervalued. But this is amongst the lowest valuations that we've seen Abbott Labs, certainly over the last decade. A $100,000 investment in Abbott Labs would have grown to $118,000. Again, a lot of it was overvaluation in 2001, but again, a very consistent dividend record. You can buy this stock today with a 3.6% dividend yield, which we think is very attractive in today's low interest rate environment. Novartis is a company that's grown earnings at 11% a year. You can see that the market has historically priced this stock at a premium. It's currently trading at a low valuation. The company has a great dividend record. Their payout ratio is pretty consistent. They've averaged significantly better than the S&P 500 over the last 11 years. But the key takeaway is that the stock is currently trading at a discount to its normal valuation levels. And then our last example will be Procter Gamble. And here you see a blue chip that the market has, almost always priced at a premium. The company's earnings growth has been very consistent. They didn't grow necessarily during the recession, as you can see here, but their earnings remained, very healthy and are now forecast to begin growing again at about the 8 to 12% level. But they've historically grown at 8.7. You can buy them with an entry-level yield of 3.2%, and the stock is currently trading at one of the lowest valuations. You can see historically, back when it was, fairly priced in 2001, you would have normally expected to get about a 1.5 to 2% entry yield. Of course, you can see what we call growth yield or yield on cost here has increased nicely. But we think with a 3.2% yield, this current undervaluation of the market makes an excellent time to be looking at any of these five companies.